Okay, so this is an awesome question on CAPM. It's a question that students hate no matter how you look at it. I mean, just look at the screen. There's so much text. But what's interesting is that this is actually pretty straightforward if we use it in steps. Okay? The first thing that I need you to do is to open your formula sheet. Either you have it on paper or you have it on, your screen. Just have something where you would have all of this like summary type of information you would need. And on CAPM's chapter, it's actually pretty straightforward. You need like 3 formulas, and one is literally the most important like formula out there. Okay, so that's really important. The first thing I need you to do is that. And we're gonna jump into this. Just please follow me step by step, and you'll see that complex questions that are maybe slightly comprehensive are actually quite easy when you put them into small little segments. So let's jump into it. And for this question, I guess I'm going to zoom in just a little bit because I know there's a lot of text, and I know students do not like a lot of text, which is fair. I mean, I didn't like it as well. Okay, I guess a little bit more. Sorry about that. I know I'm wasting your time a little bit, but it'll be worth it. Okay, so I'm going to make it simple for you from the very get-go. In this question, we're dealing with CAPM. Okay, there's just no other way to go about it. Because there's a lot of text, make it simple for you. We're dealing with a mix of CAPM. Okay, so our question has a mix of CAPM and of equity valuation. Okay, it's a very comprehensive question, and it's going to be very fun to do. So just to make it clear to you, if we're dealing with CAPM, there's only one formula that you really care about. There's only one formula that you actually need to use. It's going to be the following. Okay, typically, students fail to understand that this is just a game of a puzzle. You're solving for the missing piece of the puzzle. Okay, it's as easy as that. Boom. Cool. So we have that. And then for equity valuation, there's typically only one formula that we care about, and hopefully you're comfortable with it, and it's this one. This could also be written as, hold on, it's a common growth or common. I always like have a problem saying the name. Is it like the common growth stock DDM? I feel like I need to get some sleep sometimes. But all jokes aside, that is a formula that you want to use, and it's probably the only formula you really need to remember from that chapter. So we're starting off slowly, really going into our paces, just identifying the different types of formulas we may need with a question that's comprehensive like this, in which there's a bit of CAPM and in which there's a bit of equity valuation. The reason why we're identifying these formulas is because we really want to kind of look for these missing parameters into our question. We want to look for RF in the prompt. We want to look for beta in the prompts. We want to look for G in the prompt, right? Because then it's quite literally like 95% of the time a question of solving for that missing piece of puzzle. All right, so let's go about doing this. So let us assume that you were given the following information on the economy and PepsiCo's common stock. So you're told that the risk-free rate of return is 2.5%, whereas the required rate of return on the market is 10.67. Okay, so we're going to go about identifying things extremely quickly. So here we already know what our risk-free rate is. Okay, it was simple. They told you in the chat, I mean, in the prompt, that the risk-free rate is going to be equal to 2.5%. As easy as that. They also told you that the required rate of return on the market, so ERM, is equal to 10.67%. Now, you've identified those things. All that you got to do is look at your formulas and say, oh, I got the risk-free rate, and I also got the expected return on the market. Cool, let me highlight those. Then it's obvious that you're not solving for them, okay? You're essentially triangulating on the problem step by step by removing the stuff you already know. It's really as easy as that, okay? So now we understand that we have this. They also told you that PepsiCo's expected growth rate is 4% right now. So PepsiCo's expected growth rate is 4%. At this point, bells should be ringing, okay? We're looking at PepsiCo. That's the focus right now. We care about PepsiCo, okay? It seems pretty obvious. We care about PepsiCo's stock, okay? So just keep that in mind. And we know that the growth rate is equal to 4%. That's awesome too. Where do we have that? Well, hey, we have this right here in our equity valuation formula. So boom, now we're really in good shape. And we know that the last dividend that was paid was equal to 1.15, okay? That's also great news. So, by the way, if you don't remember, the last dividend was paid is literally synonymous to saying that a dividend was paid today. In other words, that the dividend, if you want to define it, it will be D0, okay? If we say the last dividend, this year's dividend, the current dividend, today's dividend, this is all synonymous to D0. So we know that D0 is equal to 1.15, just like that. We could go highlight this as well into our formula. Things are getting easier and easier and easier by the minute, okay? The next bullet point says that comparable companies like Coca-Cola and Nestle have betas that are trending towards 0.85, while the firm's beta is 0.57. If you read this, please take a step back and read it again, or even divide it into pieces. Let's do that exercise together. Comparable companies, so already there you know that we're not talking about PepsiCo, like Coca-Cola and Nestle, have betas trending towards 0.85. So if you read this, you could actually eliminate some of the noise. You could read this simply as saying Coca-Cola and Nestle have betas trending towards 0.85. Now you need to ask yourself a question. Is Coca-Cola Pepsi and is Nestle Pepsi? The answer is no. So if the answer is no, you don't care about this number 0.85. It doesn't matter to you, okay? So by using this exercise, by segmenting a sentence that's long, complicated, or wordy with words that you've never seen before, just break it down into segments, and you realize quickly, because you're a capable human being, that hey, that's not related to PepsiCo, okay? Then they tell you that the firm's beta is 0.57. In this case, if you kind of just put it in perspective, well, what firm are we kind of talking about? What has been the subject of this question? Well, the subject of the question has literally been PepsiCo and the general economy. So in this case, we know that the firm really relates to PepsiCo, and in this case, the beta of PepsiCo is equal to 0.57. So beta of PepsiCo is equal to 0.57. And this is great news because now, once again, we have everything we need to solve for K under the current state of the economy. That's really cool stuff. Well, let's continue reading through the question, and let's actually use a different colorway. I'm just going to do this for further use. On an exam, you may not actually see that ahead of time, but still, we're just going to do that to make things more concise. So I'll actually start using different colors as well. Sorry about that, just gotta, my bad. So assume that the following changes occur, okay? So we have changes that are happening, okay? This is very important. Changes, things are now different, okay? And we have three changes. So the required rate of return on the market decreased. So the ERM decreased to 5.5%. So now this is really interesting. We gave you two different ERMs. We gave you the first one, right? Then we gave you a change, a different ERM, because something in the world changed or happened. So in this case, you could say that ERM prime is equal to 5.5%. Okay. And then there's some noise. They're telling you after cautionary measures were taken by the Fed to fight inflation and stimulate the economy. Now, if you remember what we said prior, this is all noise. This doesn't matter to us. You can literally run through that text. It does not matter. And another thing that I'd like to do is technically, if we look at our CAPM formula, we could highlight our CAPM formula in a different color as well, because maybe we'll have to solve for K twice type of thing, because we have a bunch of different inputs. We have two types of different inputs, right? So maybe it's kind of worth doing that. Wink, wink. Maybe it's valuable. Then we also tell you that the expected growth rate of the firm increased by 0.5%. So let's think about this once again. Now we have a new growth rate, and this new growth rate prime, is 0.5% bigger than the previous one. Our previous growth rate was 4%. 4% that increases by 0.5 is equal to 4.5%. Okay, so we have 4.5%. And once again, there's a bunch of noise that we don't care about since it is considered to have a solid business, which will fight the negative effects of a potential upcoming recession. What does that even mean? But one last thing, once again, is if we have this information, maybe it's valuable to kind of like highlight it in our formula, right? Maybe we'll have to compute this twice. It may be valuable, okay? And the last bullet point is telling you the following. The firm's beta increases to 0.60, okay? Firm's beta increases to 0.60, such that the beta of the firm is equal to 0.60 in the changes, okay, when those things occur, okay? Such that now we can also highlight that within our formula, okay? And yeah, notice that nothing happened to our required rate of our risk-free rate, so that's pretty cool. There was just 3 changes, okay? These 3 changes were the ERM, which jumped to 5.5%, our G, which jumped to 4.5%, and our beta for Pepsi, which went to 0.60. Okay, pretty normal stuff. Now we're gonna read the mission, the prompt, like the real problem that we have here, and then we're gonna just kind of do a quick summary on what's the information that we just described and why it matters. Okay, so if we look at the call to action here, it's telling you that what will be the change in price, okay, per share, assuming that the stock was in equilibrium before the changes. Okay. I think there's one part that really should stick out to you. We're talking about this change in price. Okay, so let me just highlight that effectively. So we're looking at the change in price per share. Now already, for you to find this like magic like number, you would have to solve for the price. Okay, so you would have to solve for the price in 2 different scenarios, right? Because we want the change. What is a change? It's something that was in the past or something that existed that changed to something else. And you're going to measure the sigma between the two. Not the sigma, is it the sigma? There's a delta, my bad. The delta between the two. You're looking at 2 occasions and you're comparing the 2, okay? Very straightforward. So in this case, we want to compare a old price versus a new price, okay? That's what we're telling you. You want to look at the change in price. So change in price will be old price versus new price. Now, what's awesome is that if we go back to our little formulas, we notice that, hey, we could actually solve for price with our equity valuation formula. So maybe, just maybe, we would want to use that, right? Once again, we have 2 formulas and we're just kind of like, solving for the missing piece every single time. And we notice that everything that was said in this question is we could find it in those 2 simple formulas that we've highlighted. It's awesome, okay? So we just did 14 minutes of context, 14 minutes of highlighting what are the pieces of information that we actually care about and doing it step by step. Now, what I'd like to say, we're just gonna run a quick summary throughout this information, okay? So let's look at this together. We're gonna highlight this in blue. We have this section here. We're gonna call this section A. We have section A, and section A really highlights the past. We're telling you that in the past, there were the following, I guess the following state of the economy, the following, numbers, the following information. And that's what we had in the past. And what's interesting is that with all these inputs, we could have solved for K, right? With all the information that was highlighted in yellow. And we could have also solved for P0, right? For the price. We could have done that with all the information we had in A, right? So we could have used the CAPM formula because we had our risk-free rate, we had our beta, we had our ERM, and we had our RF, and we would have solved for K, right? Pepsi's required rate of return. Then we noticed that obviously within our equity valuation formula that there is a K in the denominator. And because we're like Dover, we're some explorers, we're some detectives, we're gonna plug all that stuff in and we're gonna get a price from that, right? So we could have gotten those things if we wanted to. And we're gonna do exactly that. We're gonna find all of the different outputs for our CAPM formula and our equity valuation formula for part A, all right? And then, right, because that's gonna give us the price for A. And then We could also do that for the second part, right? Which is when changes have occurred in the economy. When changes have occurred in the economy, our required rate of return on the market portfolio changed, our growth rate for Pepsi changed, and our beta for Pepsi changed as well. So we would have, obviously, if we would have to plug that in within our CAPM formula, we would get a different K. And by definition, because we have a different K, our output right here, because of our different K and our different G, would give us a different price. Okay, so that's really important. That's really cool. You'll see why it's really cool if you didn't already kind of catch on to this. So this is going to give us the price for B. And notice how our mission, highlighted in green, asks you the following thing. They tell you, hey, what will be the change in price per share? In other words, what will be the change in price between part A and part B? It's as easy as that. Okay, so what we're going to do, if that's not clear enough just yet, we're going to go through part A, which is what's highlighted in yellow and blue there at the top. We're going to go here, and we're going to solve for our required rate of return. Then we're going to plug that in within our equity valuation formula to solve for the price of part A. Then we're going to jump into part B, which we're going to plug everything in once again, but they're different, into our CAPM formula to solve for the required rate of return. Then we're going to plug that in within our equity valuation formula to solve for the price of B. Then we're going to have the price for A, then we're going to have the price for B. We're going to have two different prices, okay? That should be clear. What we're going to do is we're going to look at the change in between part A to part B, and that's going to be the answer of our question. Seems pretty straightforward. Now, I know it was a lot of text, and I know we went about it step by step, but while practicing this just once, the next time you should be fine, okay? So let's go and do this together. So I guess I'm gonna zoom out just a little bit, just such that you can kind of always have, sorry about that, the information that's needed in front of you, okay? So let's start with part A. And I guess I'll take this. I'm gonna move it here, okay? Just because I want some space for when we write. I'm so sorry if it's unclear afterwards, but look at the video. It's gonna help you out. So let's go for part A. Okay. So once again, within part A, we're going to plug our stuff in within our CAPM formula. That's going to yield us a required rate of return for Pepsico. Then we're going to plug that in within our equity valuation formula. That's going to give us a price for Pepsico, and we're going to be done with part A. Then we're going to literally repeat that for part B. Then we're going to look at the difference between the two. We're going to get our answer. So if we solve for K. So if we look at all the inputs that we have, we know that the risk-free rate is 2.5%. Okay, and we know that beta is 0.57. And we know that the expected return on the market is 10.67%. And once again, we know that the risk-free rate is 2.5%. Okay, then all that we have to do is solve for K. Once again, this is a question that I've never done in the past. It's the first time that I ever, I'm sorry about that I ever made it. So we're going to do it together. And of course, I do run the risks of kind of not being correct and maybe having like a little dyslexic error, because sometimes I tend to do that. So just let me know in the chat if I ever make a mistake. It takes me 2 seconds to, like figure it out afterwards. So what we'll do quick is that we'll notice, okay, the risk-free rate is 2.5%. We know that our beta is 0.57 for Pepsi for part A. We know that the return on the market is 10.67%. Once again, the risk-free rate is 2.5%. So all of our inputs should be okay. I'm just going to verify them one last time. Amazing. Such that the required rate of return on Pepsi would be 7.1569%. Okay. So now this is awesome, because we have the K that we could plug in within our formula for the equity valuation part of it. Okay, so this is how we're going to write it. We're going to have PO is equal to, obviously, DO times 1 plus G. We know that DO is equal to 1.15, and we know that G is equal to 4%. And now we know that our K is equal to the amount that we just figured out minus 4%. Okay, and that's going to give us a price. We're going to highlight right here. So we'll do just that. I guess I'm going to have to do that as well. We're going to have, just give me 1 sec, kind of just doing everything, because once again, it is the first time that I've done this. 1.15, and we get to kind of do it together. It's kind of cute. Over 0.071569 minus 0.04. So we're going to have 1.15 times 1.04 divided by 0.071569 minus 0.04. Like this, at least you could tell me if I made an error. We should be, we should be okay. And that should give us the price of our stock. I feel like we are good. Okay. So I'm just going to let my calculator do the thing. And boom, we get that the price of Pepsi should be, and I guess I'll write it like that, $37.88526. Okay. So that should be the price of PepsiCo's stock. And I'm going to write it, leave it right here. Okay. So once again, we plugged in all of our stuff to find our K. And we plugged in that K into our equity valuation formula. Then we found the price of part A. Amazing stuff. Now, all that we have to do now is do that for part B. Okay. I know it's a long video, but I'm also really taking my time to really make sure that you know about every single step you would need to take. Okay, so now we have part B. Part B, you really want to be cautious about the changes that we've highlighted here. Okay, so we told you the risk-free rate did not change, so it remains at 2.5%. We know that the beta changed to 0.6. I guess we don't have to write all that. We know that the required rate of return on the market decreased to 5.5%. And we know, once again, I told you, that the risk-free rate did not change. Okay, such that our K, and this time as well, I'm gonna have to plug it in. I really apologize for, for it being kind of slow like that, but it'll all be worth it. So once again, we know that it's 2.5 plus 0.6 times 5.5 minus 2.5. I'm going to do a sense check because it's the first time that I do this. I don't want to make a small error. So we have 2.5%. The risk-free rate remained unchanged. We know that our beta changed to 0.60. We know that our ERM decreased all the way to 5.5%, and all the rest should be fine. So if you plug this in and you solve for K, you actually get a really cute number, 4.3%. That's really, really interesting. And just because under the rule for the common, I always have a problem. It's the common stock DDM or the growth DDM or the constant growth DDM. I always have a problem saying the name. But just because there's a rule for the common stock DDM or the common growth DDM or the growth DDM, I don't even know, constant growth DDM, there you go. There's a rule that says that K cannot be smaller than G. For this reason, I'm going to change the question just a little bit. And we're going to say that essentially the growth rate decreased by 0.5, such that this, our G prime, will be 3.5%, because or else you won't get an answer that is actually possible. So that's just a small adjustment that I need to make. It's the first time that I made the question. I apologize if you read through it and you're like, what the hell is going on? My bad. Just, we're going to make a small adjustment. So we're going to say that G prime is 3.5%. If you know, you know. Okay? So it decreased. All right, I'll make that adjustment on the website. I'll make the adjustment in the PDF, so no worries. But still, just to be concise, we need to have that. So we're going to have RP0 formula or equity valuation formula that's going to be as follows. So we're going to have 1.15 times 1 plus 3.5%, okay, over 4.3% minus 3.5%. Okay, because it's always K minus G. So if you plug that in within our formula, you may get some cute stuff. No, I really hope I don't have to plug this in again. That's crazy. So just give me a second. I'm going to build a formula. So we're going to have 1.15 times 1.005. That makes sense. No, that does not. I can't do that. Over 0.043 minus 0.035. So I'm just going to review everything just because I make mistakes. So to find the price under the equity valuation formula, under the constant growth DDM formula, so in one shot this time, we're going to have 1.15, which is D0, times the new growth rate, the growth rate prime, which is going to be 1 plus 3.5%. You could write that as being 1.035, if I'm not mistaken. You're going to put that over 0.043, which is 4.3%, minus 0.035, which is 3.5%. And that's going to give you a really different price. It's going to give you a crazy price. It's going to give you a price of $148, such that P0 is essentially $148. Okay, so now we have the price for part A, and we have the price for part B. So that's pretty awesome. And then the last step is a walk in the park. All that you're going to have to do, and we're going to put it in, I guess, orange, you're going to have to do as follows. You're going to do part B minus part A over part A. This is going to give you a chance to find what is the change in price, okay? Such that the change in price will be equal to 148. At this point, I'm going to just round it up, minus, I guess I'll have to move it just a little bit. There you go. Just like that. Minus 37.89 over 37.89. We can do this fairly quickly. Give me a sec. $148.78 minus 37.89. Once again, please let me know if I make any errors due to inattention. It's literally so likely. But I think we should be good. So in this case, we're going to get obviously a very big growth. We're going to get a change in price that's essentially almost 3x. So you could say that the change in price is essentially 2.9266 times. In other words, you could say that the change in price is essentially 292.66%. Okay? That's how you solve a major question related to figuring out the change in price in terms of percentage. But you could also, if you want, find the change in price in terms of dollars. Okay, that's also something that you could do. And I'll write it down just for fun. So you do 148.78125 minus 37.88526. And you'd get, in terms of dollars, you'd get $110.89. Okay, so there's a few ways about doing this. I believe it's 100. Whoops, it's going to be 110.89 or 110.90, if you will. $90. So there's really three ways of writing this, but they all come into the same thing. On an exam, you may have a multiple choice where they ask you to find, like, you know, the change in dollar values, but it could also tell you to find the change in multiples or the change in percentage. It literally all boils down to the same thing. Okay, I just showed you the three ways, but this is how you solve a very, very comprehensive, long format, complicated question on an exam. But I feel like we did this pretty okay. Of course, when you study, you want to break it down into pieces. You really want to have all of the signals Slow is smooth and smooth is fast, especially when you're studying, such that when you go on the exam, this will be a walk in the park. A question that's made to throw you off will be one that's going to empower you and give you an opportunity to get that extra 5 to 10% on your exam, while everybody else couldn't. Okay? So hopefully that's not the case. Hopefully everybody watches the video and empowers themselves and does well. But listen, hopefully this helps. There's a bunch more resources on YouTube, on my website, or literally just search Isma Helps online on like Google, Safari, or even Facebook. You may find my stuff. So hopefully this was helpful.